Hello students, what I'm going to be doing in this video is question 718 section A, and instead of the required, which is already there and which already has a video for it, I'm not going to be preparing the distribution account and the current accounts. Instead, I'm going to be preparing the net investment statement for the partners for the year ended 30th of June 2009. So remember, with the partnership, the things that are different are the fact that each partner will have a current account and a capital account, and there will be allocations of interest and salaries and share of profits to the current account. And what's also different about a partnership is that you have to prepare a net investment statement, which is in place of a statement of changes in equity for a sole trader, and also in place of statement of changes in equity for a company. Okay, so in order to prepare the statement of net investment, let's look at the information they give us in the question. We've got Jade and Lilla, who are in partnership, and their partnership is called Jacaranda Paint. And they give us information at the 30th of June 2009. And the information they give us are the capital account balances. Now remember, the capital account balances do not change except for the following. The only thing that goes into the capital account are contributions made by the partners, and then if there's a retirement or admission of a partner, then the capital accounts will change. So I'm going to do that for you in section B and C, show you the changes in the capital accounts for the retirement and admission of a partner. So the capital account balances, if there's no retirement or admission, all that's in there are the contributions that the partners have given to the partnership. The current accounts have a lot more information in them. They've given us the current account balances at the beginning of the year, the 1st of July 2008. So it seems that in this question, we therefore have to process all of the entries for the year June 2009 to the current accounts. Jade has a debit balance. That means she owes the partnership $2,800 at the beginning of the year. Lilla has a credit balance. We normally have a credit balance in the current account. In other words, the partnership owes Lilla $6,500. For this year, each of the partners has made drawings. This is a debit amount, which is correct, and that's going to get transferred to their current accounts. And then for this year, we've also made a profit for the year, and that's going to be distributed to the partners in their profit sharing ratio. So the current account is going to have the drawings debited, and the profit sharing, the profits that the partners share in is going to get taken out of this profit and loss account and credited to the partner's current account. Then they also tell us additional information. On the 30th of June, Jade took old furniture that had a carrying amount of $850 for his own use. Sorry, I thought Jade was a female. I see they called Jade a male. But the transaction was not recorded. The depreciation has been calculated and recorded correctly. So we need to take that into account when we do the allocation of drawings for Jade, because this is an additional amount for drawings. So the entry for this is we're going to be increasing drawings by $850, and we're going to take it out of the office furniture cost and accumulated depreciation. That leg of the transaction we don't need to do. We only need to do the leg that increases drawings by $850. Then they tell us that there was $11,440 included for rent income in the profit or loss account. And this represents rent received for 13 months from the 1st of August 2008 to the 31st of August 2009. That's a 13-month period. We're busy with the financial statements to the end of June. So if we're going to the end of August, that means July and August have been included in there, and they actually don't relate to this year. They relate to next year. So there's 2 months of these 13 months that's actually next year's rent received, and we're going to have to adjust for that in our profit and loss. Okay, so there's an adjustment required to reduce the profit and loss, and the other leg of that transaction will go to income received in advance. we don't have to do that leg. We just have to do the adjustment to the profit and loss account. Then they tell us partners are allowed salaries, 5,000 per month for Jade and 3,000 per month for Lilla. And they also get 5% interest on their capital accounts and 5% on their opening balances. If they have credit opening balances, which Lilla does, Lilla will earn 5% interest on her credit opening balance. Interest at 8% is charged if they have a debit balance on their current accounts, which Jade does. Jade has a debit balance. That means Jade owes us money, and we charge 8% interest on that opening balance. So those entries are going to have to go through the distribution account and the current accounts of Jade and Lilla for salaries and interest. All payments to partners during the year were debited to their drawings account. So all payments that were made went to the debit of their drawings accounts. So the drawings account gets closed off to the current account, so we need to do that. And it will reduce the amount that is owing to the partners. And then they tell us the remaining profit or loss is divided between the partners in their profit sharing ratio. Because we don't get given the profit sharing ratio, what we do is we go and look at what their capital account balances are, and we work out the profit sharing ratio from that. So together, their total contribution is 200,000 of capital, and because Jade has 120 of that, that's equal to 60%, and Lilla has 80,000 of the 200,000, that's equal to 40%. So the profit sharing ratio gets worked out based on their capital balances. So the first thing we put into the statement of net investments, please make sure you know the format. You write the heading, the name of the business, and then you write statement of net investment of partners for the year ended. That's important, and you put the year end date. You will have columns for capital, distribution of profit. In this question, there is no asset replacement reserve or revaluation reserve. If there was, you would have a column for that here as well. These two will equal the total equity column. And then if you add the current accounts of the partners to that, you will get the total investment of the partners in the business. If there were loan accounts to or from the partners, that would be added here after the current accounts, but there aren't any in this question. So the information they give us is the opening balances. So we add together the opening balances for Lilla and Jade, and we get 200,000, 120,000 for Jade, 80,000 for Lilla. And we take the opening current account balances. The one account is in debit. In your statement of net investments, remember these are all typically credit balances because they're part of equity. If an amount is in a bracket, it's a debit on the statement of net investment. So in other words, this 2,800 was a debit balance on the current account. That was a debit balance for Jade, and we subtract that from the credit balance for Lilla. That gives us a net credit on current accounts of 3,700. So that's our opening balances. We add to that the profit for the year. Now the way you work out the profit is you take the profit they give you and you have to adjust it. You take out of the rental income that's been included. 2 months out of 13 months doesn't relate to this year. So if I take that 11,440, that's for 13 months. I divide it by 13 and then I multiply by 2, and I'm going to subtract that from my profit. So that means I'm taking out the income that relates to July and August, and the other side of the entry would be that that would go to income received in advance. So my profit for the year is the 136,026 minus the 2 months worth of rent income. So that goes into my distribution of profit column. That's a credit, and it goes into the total column. Then the interest on capital needs to be calculated. The partners' balances at the beginning of the year was 200,000 Rand. 5% interest on that is 10,000 Rand. So that reduces our profit. This distribution of profit account is basically your distribution account of your partnership. It starts with the credit for the profit, and then you take out the interest on capital. that interest on capital is going to be credited to the individual partner's current accounts. And if you look at the video that Mrs. Klutter put onto under subject content, you will see the recreation of those current accounts for the partners. In the statement of net investment, we just put the total amount for both partners. So the partners' current accounts have a credit balance and they're increasing by the 10,000 interest they've earned. That 10,000 is partly a distribution of part of the profit of the partnership for the year. Then interest gets allocated on the partner's current accounts. Remember, if the current account has a credit balance, which Lila did, then the interest is 5%. So that's 5% on her credit balance is 325. So Lila would have 325 credited to her current account, and we would debit the distribution of profit account with 325 interest. But Jade has a debit balance, and the debit balance has 8% interest. So in other words, Jade owes 224 Rand. So that 224 Rand would be a debit to Jade's current account and a credit to the distribution of profit for income that we've actually earned from Jade, because Jade owed us money. But we take the 325 less the 224, and that gives us a 101 debit to the distribution of profit account and a net credit of 101 to the two partners' current accounts. But that 101 is made up of a 325 credit for Lila and a 224 debit for Jade. So you can see here that the interest here comes out of distribution and gets credited to the current account, whether it's capital or current accounts that we are working out interest on. Then the salaries need to get calculated for each of the partners. Jade is going to get the equivalent of 60,000 for the year credited to her current account, and Lila gets 36,000 for the year. So we take it out of our profit distribution account, we debit the profit distribution account, and we credit the two partners' current accounts with the 96,000. Then we finally take out the balance of the profit. So we started with 134,266. We subtracted 10,000 for interest on capital, 101 for interest on current accounts, 96,000 for salaries, and we left with 28,165 balance in our distribution account, which gets allocated to the two partners' current accounts according to their profit sharing ratio. So the debit is to distribution account and the credit is to the two partners' capital accounts. The distribution of profit, all I've done there is I've shown you that it's the 134,266 minus the 10,000 interest on capital, minus the 101 interest on current accounts, minus the 96,000 salaries. That's the balance on your distribution account that's getting distributed. Then finally the drawings. They give us the amount of the drawings for each partner. We add the two amounts together, but we also have to add for Jade the 850 for the furniture that Jade took. So that's an additional amount of drawings. So we add those two amounts together and it gets deducted from the current account. So remember I said to you, a bracket means it's a debit. So the drawings are payments we've already made to the partners, and it therefore reduces the amounts that we owed them according to the current accounts. The current accounts normally have a credit balance. It's all the amounts we owe for profit, interest, and salaries, and we've subtracted the drawings from the total we owe the partners. So then you will see, if you look at the balances of the net investment statement, we've got the capital that was introduced by the two partners. The distribution of profit account balances to zero because everything in the distribution of profit account actually ends up being distributed to the partners' current accounts. So it means if we look at our total equity column, we've got the 200,000, which is basically the capital that the partners had introduced, and that gets shown as equity on the statement of financial position. If we now add up the current accounts column, the 17,766 is the total that we owe the two partners in their current accounts for the year. We had the opening balance plus the distribution of the profits for the year as interest, salaries, and the balance being distributed, and then we subtracted drawings. So we still owe the partners 17,766. So if you look at your total investment column, here we started off with the capital account and the current account balances added together. We've added to that the profit for the year. The distribution of profit in the net investment column total actually comes to 0, because what happened here is we took it out of the distribution account and we credited the current account. So the debits and the credits net each other off to give you 0 in the total investment column. So the 203,700 was the opening balance. The 134,266 is the profit that the partnership made, which has been distributed and given to the partners and credited to their current accounts. And then the 120,200 is the drawings, the amounts they've already taken out the business. So this 217,766 represents the 200,000 capital the partners had introduced, plus the 17,766, which is the credit balances on their current accounts. So those are the amounts that the partnership still needs to pay to them for the profits for the year and the opening balance for the year that hasn't yet been paid. So that means the partners have an investment in this partnership of 217,766. So what I was aiming to do in this question, instead of the original question which asked you to do the distribution of profit and the partners' current accounts, I've actually shown you how it looks if you were asked to do the statement of net investment of partners instead. So that's part A. I'm going to do part B and C on a separate video.